Excellent.
Over to you, Andrew.
Brilliant. Well, good morning. Welcome along to an important subject that some people may think is rather tedious. I'll try to not talk for very long, and if you've got questions at the end, just please shout. Thank you to Dawn and Catherine here at 7X Chamber for letting Hilden Park Accountants do this session, which, yeah, hope you'll find useful. I'm sure you've heard it said that there are two things in life that are certain: death and taxes, and I plan to talk mainly about tax. There are a few recent changes that will affect small business owners, and if you'd like to discuss anything I haven't covered, please shout, interrupt, or email me afterwards. Just to tell you a very small amount about me, I'm an accountant, tax, business advisor, director at Hilden Park Accountants, and we're one of the 7X Chamber sponsors. I started my first job in July 1984, and I'm still there. I spend far too long sat at my desk 5 days a week. Although if you're an early riser and visit Dunallen Park in Tunbridge Wells, you might see someone walking around with a pair of binoculars, and that'll probably be me. Now, bird watching is my hobby, nothing sinister. Next. So I'll start off with national insurance, but there've been changes to dividend tax, corporation tax, big changes to corporation tax. In fact, there are always changes to capital allowances, and I'll go through a few of the other bits that haven't changed much. IR35, as Ros, I'm sure you're well aware, has a few things going on there. So let's get started. National insurance, I'm trying to use two mice at the same time. So, and I hope it doesn't look too weird. I'm looking up to the screen above my laptop, but so the employees' national insurance rate increased from 12% to 13.25%. A lot of the rates have gone up by 1.25%. That happened this month. From April next year, the additional 1.25% will apply to individuals that have reached state pension age, although that will be called something fancy, a health and social care levy, I think. No national insurance for employees or self-employed on earnings up to just under £10,000 per annum. And that's being increased to just over £12,500, which is the same as the personal tax allowance from July. The government have actually muttered for years about bringing these in line with each other. So how long they'll stay together, I don't know. The self-employed national insurance rate on earnings between £9,880 and £50,270 has risen from 9 to 10.25%. So they get hit as well. Higher rate taxpayers continue to pay national insurance on earnings above £50,000, previously at 2%, now at 3.25%. That's the same for both employed and self-employed people. And employers' national insurance has increased from 13.8% to just over 15%. So any employers will notice a hit in their PAYE and national insurance payments each month from next month. The government have done a very small thing to help. They've increased the employment allowance from £4,000 to £5,000. There are exceptions. Not everybody can claim that, but most small companies can. And if you're part of a group, you have to share that or choose the company you want to use it for. So let's move this forward. Dividends. Again, there's no national insurance on dividends. So HMRC, the government have increased the tax on dividends by 1.25%. from the 6th of April. First £2,000 are usually tax-free. I say usually because if you're on a, say, £99,900 and you have £2,000 of dividends, you'll suddenly find yourself paying more tax as a result of going over the £100,000. And there are various other scenarios where £2,000 isn't really tax-free. Tax on dividends, where an individual's income is below £50,270 is now 8.75%, used to be 7.5%. And the tax on dividends above that level is now 33.75%, used to be 32.5%. So again, the 1.25% increasing on all dividends, really. The super rate of tax on dividends, again, that's increased now 39.35% if you earn over £150,000 per annum, or where earnings are over that level. So that's national insurance and dividends. Corporation tax, really that's taken a bit of a hit. I mean, when I started in work as an accountant, I think corporation tax rates were at 33%. So they've gone down and they've gone down and they've gone down, and they're now sitting at 19%. And there was some talk that they were going to go down to 17%. That's been shelved now for the foreseeable, at least. And yeah, still currently 19% for all companies, but corporation tax rate will go up to 25% from April next year. For small companies with taxable profits under £50,000 per annum, the corporation tax rate will remain at 19%. So some good news. Companies with taxable profits over £250,000, though, the rate will be 25%. So a fairly decent hike. Companies with taxable profits between these numbers will pay effective rates of tax between 19 and 25%. So just need to be a bit careful, and group companies need to be a little bit careful, but I'm not going to go there today. If you've got any questions or know anybody who has got questions, please scream. So a bit of a tip: if you need to buy equipment, vans, electric cars, they're all a good way of reducing profits in a good year. So if you've got one good year from next April, and then amongst level profits, you might think of moving some of your capital expenditure into a good year to enable you to take it or to not pay tax at 25%. So I would just always say, speak to your accountant first before you do anything. Capital allowances, especially when it comes to buying equipment. Capital allowances, yeah, when you purchase an asset, you can usually claim capital allowances. And so even though it won't directly affect your profit in the year of purchase, it can normally reduce your taxable profit. 130% super capital allowances on some assets, but note the small print. For example, electric cars have to be unused, new and unused, in fact, to be able to claim the allowance. So buying a 6-month-old, I don't know, BMW i8 isn't going to help you as much as you might have thought from reading headline tax news. A BMW i8 actually saved one of my clients over £20,000 of corporation tax one year, fairly recently. But you do have to be able to spend £100,000 plus on a car in the first place. I'm on the right page there, yeah. Do be careful with company cars though. A lot of cars are not worth putting through the business. You have a big benefit in kind charges, personally. And for instance, if you buy a 5-year-old diesel Land Rover, it'll hurt the company a lot, as well as hurting your own or your employee's pocket. So yeah, just be careful. And again, please talk to your accountant before making any big decisions like that. I will mention a few other things that haven't changed because I think they're important. The pension allowances, please, if you think pension's a good idea, speak to a pension advisor, but for tax purposes, you can spend, I mean, they can be really good for reducing company profit and also personal tax relief. You can pay up to £40,000 per annum into a pension allowance, and you can use previous years unused allowances as well. You can go back 3 years. So I've got a client who, they're a couple, and they've just decided they've had a good year, a very good year, and are between them and have managed to put in over £250,000 worth of pension payments. That was last month. That helped reduce their tax bill and hopefully will help them in the future as well. So next, really, what will be best for you? I'm just thinking, with the tax rates that have changed and are planning to change in the new year, next year, April 2023, the small salary corporation tax at 19% and dividends might not work so well next year if you're a small company and taking a small salary and the rest in dividends. You really have to look at your expected profits in advance. So really need to plan in advance. So think about it now. Definitely next, after Christmas, I would say sit down with your accountant, really look thoroughly at what you're going to be projecting to make in the future, well, that year and moving forward, and sit down and work out whether you even still want a company, whether you'll be best off as a sole trader or in partnership. Yeah, and work out the best way of taking money out of your company or out of your business. Lots of things to think about, really, and lots of different scenarios that I can't really possibly go into on a small, short seminar like this. So limited companies, so it still offer some protection if things go wrong, assuming you've been running the company in a proper manner, whereas sole traders won't offer that protection. Small company tax rates, 19% still apply for companies if you're not making big profits. National insurance rates have risen, tax on dividends have risen. So yeah, just things to think about. If you are starting a new company, you can get your other half to invest into your business, and they would then be entitled to receive dividends. But there are plenty of other considerations there. The amount you can each earn or receive from other sources, anticipated upon future profits, etc., make a difference. You'd receive 2 lots of capital gains tax allowances if you sold your business one day. And at the moment, individuals each have £12,300 of capital gains tax allowance and £1 million worth of business asset disposal relief. So having shares spread out can help if you're going to have a business that's going to do well in the future. Can't remember what the next slide is. Capital gains tax, yeah, I've talked a bit about that, but no changes, but are opportunities, yeah, and shout if you want to discuss anything. VAT, no changes to the VAT threshold, or not really many changes to the VAT at all. The VAT registration limit's still £85,000, and if you are VAT registered, this is a change that was announced recent. Well, it's been on the cards for ages. All VAT registered businesses now have to be registered for Making Tax Digital, which broadly means you have to have software, for instance, Xero, to file the VAT returns. So please shout if you've got any queries on that or need any assistance. I've got one client who's moaning a lot about that. He's 75 years old, running a business quite nicely using paper and using software. He's not a very happy chap at the moment, but even, I mean, we're helping him, and you don't need to do a lot, even if you have Xero. The big one that a lot of people are talking about, and I'm not going to talk for very long, because you're probably bored with my voice for a start, but again, it really depends on your circumstances. IR35, whether you're a contractor or not a contractor, if your work is for a large company, they will decide whether you fall into IR35 rules, and may insist you are employed. They might not, but it's for them to decide. This is really if you run a personal service company or do a lot of your work for one company. If most of your work is for a small company, the onus is on you to decide. And I'd recommend you go through the HMRC checkpoints to see what answer you come up with. I can guide you to them. I'm sure Ros probably could as well, I don't know. And a contract for services, I'm all in favour for those to be drawn up for, if in any doubt, but please discuss that. It's too important to just go along doing work for one company without thinking about it. And also, I've had something I've come across for last week. I had a client who I really don't have much dealings with during the year. He runs a company. He has a couple of other small companies on the side, has a salary in that company. And all of a sudden I saw all these other payments, consultancy payments going through. What are these? Oh, these are payments to my other company. No, I don't think so, was my answer. So yeah, just talk to your accountant before you do anything like that. And death. No changes here really, but again, please ensure you have a will, speak to a lawyer about that, have a shareholders or partnership agreement in place if relevant, and a lawyer again would be best placed to help you with that. And at least think about inheritance tax, calculate what tax might be due, if anything, and again, I can help there. And how any liability would be settled if there wasn't the available cash. I can't say that enough. So no changes, but please do think about it. Really, I've whistled. That's just our reception. If you've got any questions, please shout now. I've talked very quickly, so
one from me, Andrew. Very simple one. The changes to Making Tax Digital, for that. Has that come into effect, or is that going to come into effect?
That has come into effect.
Right, thanks.
There are other so it's come into effect for VAT for small VAT registered people who have income of less than £85,000 who didn't need to be making tax digital compliant up to now.
Mm-hmm.
But for VAT returns filed after, not quite now, so the 8th of May, from the 8th of May,
Mm-hmm.
You will need to be MTD compliant. For income tax, it does not quite, you don't have to be on it quite yet, but will do.
And are there dates for the income tax side of it?
I think 2025, he says nervously.
Right. And one other really daft question, really, but people, there's a mileage allowance of that 45p a mile.
I know, it hasn't risen for more than 10 years.
I can't remember it being anything other than 45p a mile, to be honest.
Oh, I'm older than you then.
Yeah. So who sets that? And is
It's
it
the
likely to
government.
change?
It's the government. I mean, you can pay yourself whatever you want for
Yeah.
mileage, but the tax-free amount is 45p a mile. Yeah. So yeah, if you've got a well, soon any car, I think will be costing more than that. It's £10,000 for the first 10,000 miles, 25p a mile thereafter for business miles. Is what you can claim, or you can put through your business.
Yeah. Okay.
So, and that's, I mean, that's worth having. That's you know, and for many people, especially if you've got an electric car, that's yeah, it's worth doing. If you've got a 10-year-old Land Rover, I'm afraid you won't be in the money with that.
No.
Can I ask about working from home allowances? Because obviously many more people are now doing that.
Yeah.
If you've got two directors both working from the same house but claiming separate rooms, how much can you claim?
I think it was £6 a week at the moment, has been, I think, he says. You can make back claims. So last year, I'm sure it was £6 a week. The year before, it was £4 a week. And you can make back claims.
Okay, thank you.
That's good. If just please email me or give me a call if you've got any other questions. Other than that,
I don't have any questions, but thank you for that, Andrew. Really, really clear and simple. So that was, I was a bit worried that I wouldn't be able to follow, but that was really, really useful, given a lot to sort of think about and go away and sort of have a bit of a deeper dive into, but I'm sure you'll receive an email from me as a follow-up.
No problem at all. No problem at all.
Well, thank you very much, Andrew. It's been fascinating as always.
Not sure it's a fascinating subject.
It depends how much. It depends how much tax one wants to pay.
Yeah, indeed, yeah. But there are ways to. There are ways. As long as you, I think forward planning is really important. Really, I think that's what I would say.
Thank you very much. I'll stop the recording now, and then if anybody's got any chit chat that they want to carry on with, then you can. Thank you.